Hello and welcome. You're watching Money, Money, Money. I'm Samira Abdi, and if you're wondering what happened to our weekly set, well, let me tell you, we're here in beautiful Bangalore, and with us we actually have two master investors. So we have Rakesh Rawal and Lavai Navlakhi, who between them would be having at least half a century of combined experience in advising people. Or have I overshot it?
No, you're very much on the line.
Underestimated. Okay, so that's brilliant because that's a lot of advice that's going to be coming our way. And not just that, we also have with us two investors who between them would be having at least half a century of investing experience, right? You've been investing for at least that, if not longer.
I wish I'd had that much of experience. If I'll tell you.
Time-wise, yes.
Alright, so I'm sure there are a lot of stories that you want to share with us. Let's get cracking because we have between all of us now over a century of things to talk about. So let's get started. Mr. Chandrasekhar, Mr. Khandwala, thanks very much for being a part of our show. You were telling us that in this, half a century or 25, 30 years that you've been investing, you've had a lot of memorable experiences, right? So take us through how your journey has been.
Well, first and foremost, to those who are listening, I would like to say that, frankly, I wish I'd started a lot earlier. I think I started too late in the game. Most of us think that either you don't have enough money or you don't really have the time, etc. But I really think you should start thinking of investing as early as possible. Second, in my view, I had the most extraordinary luck or lack of luck. Because whatever I touched, some people it turns to gold, some people it turns the other way. So whenever I put money in the stock market, it would tank. Whichever stock I touched would go south. If I bought a house, the markets would crash. I invested in the Indian stock market, it started dropping like crazy. I pulled money out, the next week the Dow had the biggest increase in the history of the Dow. So I decided, rather than do it half-baked, where you really don't know and you're just casually getting information from here and there, this is an area where you need some help and some expertise, and that's one of the lessons I learned.
Okay, so that's that's a brilliant lesson actually to have learned, because otherwise you'd just be into contra investing, right? So everything that you want to invest, tell others not to. But what about you, sir? How's your journey been?
I think what Shekhar has said, a lot of it is true and applicable to me as well. Because earlier when I was investing, you met somebody at a party and you listen to them talking about a particular company is doing well and the share is going to go do better. So you go ahead, next day call somebody and buy those shares.
Those tips actually.
Yeah, but then you don't follow it up because you don't meet that guy the next time when he tells you that now it's time to sell, but that information doesn't come to you. So it kind of went on that way for a while, and then things began to change. Because then the planning came in and the asset allocation came in and so on and so forth. But also, I think investing early is very, very critical.
Okay, so that's great. So one thing that both of you agree on is that investors should begin as early as possible. And that's in fact, something that every expert has been telling us, that invest early, gain from the magic of compounding. But in theory, does compounding really work that well? Because you don't hear of so many people saying, oh, I started 25, I'm a millionaire today. Is it really just like theory and not so much in practice?
Well, it's like there's a theory is there. If you practice it, then you'll get the results. The problem is that we go thus far and then withdraw. So therefore, if you look at the Sensex value, 1980 it was 100 and it is 27,000 odd, 28,000 today. That's about a 17% compounding, right? So if you had just bought the Sensex, you would have had a 17% return on investment, right? The problem is that you go through volatility, which is ups and downs, and then you think that, hey, when the market is coming down, everything is going to come to an end and you withdraw, and then don't enter it again. So the fact of the matter is that passive investing for long periods of time also has led to fantastic results.
But Lavai, my question to you is, at 25, if someone wants to begin investing, okay, that's a time when you've probably taken a student loan, so you have the responsibility to pay it back. You're probably looking to start your life, you have a home that you must buy, so you must take on fresh liability. Should you invest? Should you look at your liability? What should be a person's priority at that time?
I think as investment advisors, our sort of primary responsibility, which we keep telling our clients, is to protect risk first. And I think that's the number one lesson that people need to take on board, that you want to make sure that you don't lose whatever you've built through something which is, sort of sporadic or without any sort of care. So I think protecting risk is extremely important. After that, you need to start investing.
I'm sure that's good advice, but you have questions for our experts?
Yeah, one of the questions that I have is, one talks of risk, right? So take me, for example. It's again a self-perception to some extent. My perception of myself is that I'm an average risk guy. But at the same time, I've also run a business. I've been a sales guy. I've done all those things in life. I also know that nothing ventured, nothing gained. Right?
Sure.
There's a direct proportion between risk and reward. So the question I really have is, how do you really establish the real risk appetite of a person? Is it just trial and error?
Any kind of management is goal-driven, right? Now you can't do managing of money without establishing a goal for yourself. So the starting point of this exercise is that you establish a goal. The goal for money would be returns, right? So you establish as to what return you would want to look at. The next thing that you have to do is that if you have to achieve those returns, what kind of strategy to follow? What is the risk that you need to incorporate in your portfolio? What asset allocation to use? There is no simple answer to risk. There is no simple answer to make an assessment as to, hey, if the market is down so much, your portfolio is down so much, you will be able to accept it. You have to have hurt. Anybody who loses money will be hurt. It's the extent of hurt and whether it propels you into panic action. That is what you have to safeguard against.
Add to that risk question that you raised, and there are two parts to it. There's one that you mentioned about being a business owner and taking the risk. And we meet many clients or business owners who are actually very risk averse because they say they take all their risk in their business. That's number one. Number two, I think it's very important for you to separate out what is your business goals and your personal goals. The other part that you spoke of risk, I think there are scientific ways of doing this. So there is a risk tolerance test that you do, which actually will throw out and tell you that how will you react to risk, how will you react to falls in the market. And there are, good set of these risk profile tests available. And as investment advisors, now we need to run risk profile tests. And the third is the capacity to bear losses. So if you are in retirement and you say, okay, my risk capacity is X, but you realize that if the market fell by 20%, you'll be wiped out in X amount of time. Then so three factors actually scientifically to take into account for it.
Alright, so that sounds actually quite interesting and something to ponder over. So we'll take a very quick break, and when we come back, we're going to tell you how much diversification is actually too much diversification. Stay tuned to Money, Money, Money.